myself. I'm Richard Stimpson. I've got a very long background with experience with accounting. I started accounting. I was in the military for 20 years, retired as a field grade officer, and the government was very kind to me in giving me degrees that I could use in my accounting work now. They gave me an accounting degree, a computer science degree, and also a management degree. So I'm greatly able to help my clients not only in accounting, but in managing their assets and in managing the businesses with business trusts also. So I've been doing this now myself for 37 years in my accounting business, and about 27 years ago, now coming up in August, it'll be 28 years, I was introduced to a Spendthrift Trust. And I first had to say, well, what is a Spendthrift Trust? It took me a little while to do some research and digging into it, and I really liked what I saw. Once I found out that this thing was a very, very powerful tool for not only protecting your wealth, but the way now this trust is designed, it can actually help you to grow massive amounts of wealth within the trust and defer the taxes on what used to be a lot of taxable income through all that passive income, that interest and dividends and capital gains on selling properties and things like that. So I have a lot of clients that are able now to keep that money working for them within this type of trust. Go ahead and go into the presentation itself. Now let's take a look at when you should create one of these Spendthrift Trusts. The Spendthrift Trust, first of all, we'll go through the structure of the Spendthrift Trust, so you've got a little bit of background on how the trust is set up and how it operates and works. The trust has a grantor. We call it that, the settler. That's the individual who directs and creates the trust. He legally conveys the trust over to a trustee, and then with our trust, he permanently steps out of the picture. Unlike 99.9% of all the other types of trusts out there, where the settler or the grantor stays with the trust, is usually the trustee and is usually a beneficiary at the same time of the trust. With our trust, with the Spendthrift Trust, that is not the case. The settler only creates the trust and then legally conveys it over to a trustee, and then he steps out of the picture, can no longer ever be a trustee or a beneficiary of that trust. The compliance overseer, the settler sets up with a compliance overseer, and this compliance overseer is the manager of the trust and assists in it and directs all of the documents and actions that the trust has. Compliance overseer, in essence, is the guardian, the manager, and the overseer of the trust and its assets. And what's unique with the compliance overseer is the compliance overseer can stay in the background, doesn't have their signature or anything on any of the trust documents. He can kind of oversee everything, direct everything for the trust, and stay in the background. A trustee is appointed, and that's the trustee. That is the person who performs all the actions, directs taking the direction from the compliance overseer. It's also the individual who's got their name signed on all the documents, the trust, the tax returns, any other legal papers that the trust needs signed. We always set up a successor trustee with our trust so that any time, none of us ever know if we're going to live the next minute or so, let alone the next year or so. So we always want to have a successor trustee appointed so that if something should happen to the trustee, a successor would step in immediately so there's no interruption in the operation of the trust. The beneficiaries of the trust are those individuals that the trust is really set up for. The trust is set up for the benefit of the beneficiary. They're the individuals that will receive the benefits of the trust. There's kind of a little schematic here on how that is done. We have a settler. As I said, the settler creates the trust, turns it over to a guardian of the trust. That guardian appoints a trustee. The trustee then assigns beneficiaries to the trust. How it is the trust is written for. It's written in compliance with, and we have a certain way that the trust is set up and written. Trust is written to comply with Scott-on-Trust law. That's the basis for our trust, is Scott-on-Trust law. It's also based on the restatement of trusts. That's a document that actually spells out how trusts are organized and set up and operated. And good old, the last one, you notice is you'll set these things, if you look at them, they're in priority. Scott-on-Trust law is first, reinstatement of trust is second, and the good old Internal Revenue Service, we can't get away from them, but they're at the bottom of that list, and we'll go through a reasoning for that here a little bit later on. Why do we have this triple compliance with our trusts? In order for the trust corpus must be protected from turnover orders by any court or judge, with the exception of fraudulent conveyance. This is the main reason for why we have this triple compliance. We want our trust to be protected 100%. A lot of times we call our trust a titanium vault. And if things are done correctly with the trust, it in fact accomplishes that. No court, no legislative body can touch anything from our trust. The Spendthrift Trust it's complex, stands on 5 legs, and that first leg is complex, it's discretionary, it's a non-grantor, it's irrevocable, and let's go into what each one of those, and the spendthrift provision too, wasn't on that slide. The Spendthrift Trust is complex for a reason. In order to serve the beneficiaries of the trust and protect the corpus of the trust must be complex in nature with plainly stated terms and conditions. Almost all of our trust documents are written in such a way they're produced and written by an attorney, but you don't need to have an attorney sitting right beside you when you read our trust. You can read it and understand the terms as plainly stated terms within the trust document itself. It's discretionary. That means the discretionary terms and conditions of the trust are established to ensure the absolute and sole discretionary power of the trustee in determining the distribution of the corpus assets to the beneficiaries. This is a very unique feature with our trust. One of the key features with it, this is the main reason why our trust complies with the Internal Revenue Service and we do what we do, is because it's discretionary. Almost every other trust out there that we have, it's not discretionary. The trust has to distribute X, and you got 5 beneficiaries. They have to distribute 20% every year of all of the income from the trust at equal portions to each one of the beneficiaries. Our trust, though, is discretionary. The trustee can, at their discretion, determine who gets what and how much they get from our trust. I always use the example of the trust has 5 beneficiaries. The trustee, at their discretion, gives $1 to one beneficiary, $1 million to the second beneficiary, and 0 to the other 3 beneficiaries. None of them can complain or file any court actions or anything else against those actions of the trustee. Completely discretionary at the trustee's discretion. If any single percent of the corpus is designated to be held or distributed to any one or more beneficiaries, the discretionary provision of the trust would be violated. What happens when this takes place? This wouldn't affect the asset protection. We still have the spendthrift provision of the trust. We just lost the discretionary provision, which means we lost the access to the Internal Revenue Code. Title 26 of the IRS Code, mainly Section 643 of the IRS Code, specifically says at the discretion of the trustee, income is declared extraordinary dividends. So without that discretionary event within the trust itself, then we would lose that IRS protection and all taxes would be due. Spendthrift Trust is non-grantor. The non-grantor designation exempts the trust from any alter ego status that brings into action the management or beneficial enjoyment by the settlor. As we said initially, the settlor steps out of the picture, no longer is part of the trust. That's why the trust is called a non-grantor trust. If the creator of the trust had management ability or anything like contact within the trust, or had access to the corpus of the trust, or in its beneficiary, it would become a living trust, or would have no tax advantage and no asset protection. So that's a big factor as to why our trusts are non-grantor, so that the one granting the trust, creating the trust, doesn't have any benefit and has no advantage of the trust at all. Doesn't receive any benefits from the trust, and that way then we can gain the tax protection within the trust. The trust has to be irrevocable. In order to have asset protection, the trust must be irrevocable and non-grantor. When assets are irrevocably transferred to the trust, and we say transferred, we mean legally sold to the trust, they may never revert to the one who is making the endowment or transfer or sale to the trust. We say that can't never revert back to them but the trustee could sell the assets to anybody that they want to sell them to, but they can't just revert back to the original one that owned the trust. That's what our non-grantor trust status does for the trust. It just makes it all irrevocable. The asset, it now belongs to the trust, and it cannot go back to whoever originally sold that asset to the trust. All of your other types, your grantor type trusts out there, you can put an asset in the trust, and the next minute you can take that asset right back if you so wish. That cannot happen with our trust. What about the spendthrift provision of our trust? The spendthrift provision of the trust is the critical element of the document. The trust corpus cannot be penetrated to reach the assets of the corpus, except for fraud. No judge, jury, no judge or court can issue a turnover order against the property, a properly constructed trust. So this means then that this is back to our point that this type of trust is a titanium vault. There's no court in the land that can touch any of the assets within the trust. One of the ideal aspects of this trust too, courts can't touch it, eminent domain is no longer applicable with any of the assets, any land that's in our trust. I have my ranch in the trust. They want to build a highway or something through my land, they're going to have to pay me real top dollar to get any of my land. There'll be no eminent domain. What can the trust do? We have a provision within the trust that we do tax deferment. We do not have tax avoidance or anything like that. We have tax deferment. We delay the payment of taxes. We cannot avoid the taxes. We can't eliminate the taxes. We just delay the payment of taxes. Provision within the trust. Taxes on interest income, dividend, capital gains, rents, royalties, all of this is passive income and meets IRC 643 and can be tax deferred at the discretion, again the discretionary provision of the trust, at the discretion of the trustee. Those passive type incomes can be tax deferred. And with our trust, unlike your 401ks and your IRAs, where you have a minimum distribution requirement when you reach age 70, with our trust there is no required distributions at any time. So you could have your trust in effect for many, many years and have no distribution, no requirement for any distributions of that income. This income will not be taxed until the funds are actually distributed to the beneficiary or even to a trustee. A trustee could pull dollars out of the trust. They'll pay taxes when any money is pulled out by an individual from the trust. What are some of the authorized expenses of the trust? Any expenses, of course, that are in accordance with the trust document. Expenses needed to operate, maintain, or manage the trust or its assets, i.e. any interest, taxes, repairs, maintenance, contributions, legal fees, tax preparations, supplies, materials, insurance, bank fees, on and on and on. Anything that's authorized, that is an authorized expense of the trust. Expenses needed for the education, training, medical care, or even well-being. That's one of the factors that you'll not see with any other type of trust. We can, the trustee at their discretion thinks that something is for the well-being of the beneficiary, it becomes a trust expense. That would be any medical, dental, eye care, over-the-counter medication, vitamins, chiropractic, those type of things which you can't deduct on your personal tax return. Could be, because of the way our trust document states, it could be a benefit of the trust and be an expense, a legal expense of the trust. In other words, most of your normal expenses that you used to have on a monthly budget can now be trust expenses. With the exception, we do have some exceptions, an exception to everything. We do have some exceptions with the trust. We call them the 3 F's. Food, clothing, and entertainment. So for the exception of that food, that clothing, or personal grooming, going out to a movie, those type of things, then are most of the other things in your monthly budget, they'd be greatly reduced. So you'd have just those expenses. Now, if you look at your monthly budget and you take out just the food, the fun, and the entertainment type thing, and the clothing, and you look at how much that is of your budget, that's the only thing now you'll have as personal expenses. Everything else can be expenses of the trust. This will mean that the beneficiary the beneficiary needs for a monthly income will be greatly less than what they've ever had to have before, which since the trust is paying for most of what used to be their monthly budget. Let's go on to some more. All the expenses. Here's one of the stipulations with the trust though. All the expenses must be paid to a receiving party, i.e. a third-party individual. Cannot be paid directly to a trustee or to a beneficiary. Remember we said that any money paid to a trustee or a beneficiary that's not a trust expense, a reimbursement, say, of a trust expense, is taxable income to the trustee or the beneficiary. So all money must go to the third party, not directly to a trustee or beneficiary. The trust must maintain receipts. Like in most businesses, you find you got to have receipts for all your expenses. This is something now that a lot of my clients are not used to, keeping receipts on things that used to be personal expenses that are now trust expenses, and they have to now start keeping receipts for all their expenses. And I recommend also that you have for things like travel and entertainment, those questionable type expenses, you do the same thing the IRS requires for businesses. You have to write on the back of the receipt the who, what, where, when, and why to make sure that those questionable type expenses like travel and entertainment are justifiable expenses for the trust. What about for minors or underage or incapacitated beneficiaries? Minor would be somebody under the age of 18. Underage is under the age of 21, or any beneficiary that's incapacitated, legally incapacitated, medically or anything like that. Those, all their expenses for these minors, for children underage, children or incapacitated beneficiary, are authorized expenses of the trust. The only exception there would be entertainment again, but their food, their clothing, all of that would be authorized expenses of the trust. Everybody else except those three categories, food and clothing, are not authorized expenses of the trust. Payment to a minor or underage child or incapacitated beneficiary, though, must be paid to the parent or the legal guardian, not directly to the beneficiary, or again, it would be taxable income to them. We tried to not do that. Our Spendthrift Trusts are an extremely powerful instrument, as been shown in these prior slides. If used properly, it can virtually defer almost all of your current tax liability. The only expenses that are not authorized expenses of the trust are those three personal expenses that we mentioned: the food, we call food, the fun, and the fashion. The food, the clothing, and the entertainment. With the exception of those items, then, most everything else will qualify as trust expenses. Let's take a look at some examples here, just to give you an example of how powerful this particular trust is. Let's say you have a trust that has income of interest, dividends, capital gains, rents, and royalties, a total, let's say, of $196,500, around a nice number. And you got some expenses. You got medical, education, you got house and vehicle expenses, plus you got some other trust expenses that are authorized expenses, another $10,000, let's say, for total expenses of $43,000. So when you take a look at the income of $196,500, expenses of $43,000, you end up with adjusted income of $153,500. Let's say all those expenses would be authorized on your personal tax return normally, and the income, of course, has to be reported. If you didn't have a trust, you'd be paying around $20,119 for a married couple filing jointly without any children. And that's just federal tax. You'd also have state tax if you're in a state that has state taxes. So if without the trust, you're looking at a $20,119 tax bill. But with the trust, that $153,500 is all extraordinary dividends declared by the trustee, because it's all passive income. The interest, dividends, capital gains, rents, and royalties, all that $196,500 is all passive income. All meets the requirement of IRC 643 and can be all declared extraordinary dividends by the trustee, moved to the corpus of the trust, and the taxable income becomes zero. No taxes paid at all. That's a tax savings right there, $20,000, a little over $20,000 just on that one example. Let's take a look at defining education. The term education is determined to be an ascertainable standard in accordance with Section 2041 and Section 2514 of the IRS Code, and shall include but not be limited to enrollment in a private elementary, junior, or senior high school, including boarding school, religious school, or academy, or even homeschooling, something you normally can't be deducting on your personal tax return, but in our trust, homeschooling would qualify, or just any other type of schooling that you wanted to have for the child. Undergraduate work, graduate studies in any field at all, any university, college, private, state, or religious school, any of that education would be qualified as trust education expenses. Specialized vocational or professional training or instruction at any institution, including private instruction. I have a ranch here in North Texas, and I want one of my grandkids to learn how to do welding or something, let's say. I could bring a welder out here and have them teach my grandchild how to weld. That would be an authorized education expense for that beneficiary. Any other curriculum or activity that the trustee may determine, again, it's a discretionary trust. The trustee determines that it's useful for the development and abilities or interests of the beneficiary, and that could include athletic training, musical instruction, theatrical training, the arts, and even travel. We use the example, if you want to take your beneficiary, let's say, to the Smithsonian Institute, or go to Mount Rushmore, or to some of our state parks, national parks, that could all be determined to be education for that particular beneficiary, and it would be tax deductible, or it would be let me get it out, spit it out right here, get tongue tied. It would be an authorized education expense of the trust. The term education includes distributions made by the trustee for expenses such as tuition, room and board, clothing, fees, special fees, memberships in school-related organizations, and fees with regard to anything to do with the education of the beneficiary, to include books, supplies, tutoring, transportation, and even a reasonable living expense. So to give them allowance for a living expense, that'd be an authorized expense of the trust. You can't deduct most of those expenses on your personal tax return under education, but in accordance with our trust document, then those expenses would be education expenses and could be deducted. Most education institutions have what you call a student account, because we're back to that same principle we talked about before. The money can't go directly to the beneficiary. So what do? Most of the colleges have what we call a student fund or a student account. You send the money to the school to be put into that student's account. They then can draw out the funds they need for that reasonable living expenses that they have. Because remember, as discussed earlier, payments must be to a third party. Can't go to the student itself. Go to the student account fund would qualify as not going directly to the beneficiary. First and foremost, all property, assets, and values in the corpus of the trust are for the benefit of the beneficiaries of the trust. The trustee is just the manager, caretaker, and keeper of the trust corpus. This is important because we're going to take a look at what happens here with the trustee. While the trustee holds this authority, they manage, upkeep, and take care of the assets. They provide access to and supply all the things needed by the beneficiaries, or whatever the beneficiary wants or the trustee determines is good for the beneficiary for their well-being. This is their fiduciary duty with regard to all trust business, regardless of its nature. But what about the case of the residence, the personal residence? The trustee may be living in that residence. Well, the trustee is the caretaker of the property, and that property is also used for any trust business. But while living in that house as a trustee, the personal use of that house could become a problem. The Internal Revenue Service indicates that if the trustee lives in the trust-owned house, lives in or uses the trust-owned vehicle, then the personal use of that property would be considered taxable income. So we have a mechanism of getting around that by just setting up what we call a lease agreement. So however, the entire property, though, is held for the benefit of the beneficiary and used for that purpose alone. The space that the trustee uses for personal use, we'd have to have some way then of of not having to declare that as income on their personal tax returns. Thus, most trustees declare some amount on a monthly basis for staying at the property. This amount is usually small. A solution to the potential of income declaration on their personal income tax return would be for the trustee to pay a small amount of rent or lease to the trust for the personal use of the property. Now, you use the example all the time. $1 million piece of property would probably say lease for on the private marketplace for anywhere up to $3,000 a month in rent, or even more sometimes. But for this purpose with the trust, the trustee is only leasing the personal use. That's the sleeping accommodations at night, eating at the table, or watching a movie in the living room. That's the personal use of the property. So they have to reimburse the trust for that personal use. If they don't reimburse the trust through a lease payment, then they would have to declare that as income on their personal tax returns. So with regard to the trust transportation, we find the same thing is true. The trustee uses the trust vehicle and trust transportation modes for the business of the trust. The trustee need only to declare the actual mileage used for personal use during the time they use that transportation. An estimate of this mileage can be given, and this is the amount then could be added to their personal tax return, or again, we have a mechanism to go around that. We actually lease the use of the trust-owned vehicle. Everybody's used to, in business anyway, so you're used to keeping track of your mileage using a mileage log to keep track of your business miles. Well, with the trust, in essence, all you need to do is keep track of your personal miles and then reimburse the trust for the IRS-approved mileage rate. What about operating a business or a farm? So we have in existence the beneficial trust is really set up to run just passive income through the beneficial trust. So we have a problem when we run a business or a farming operation. That's a pass-through activity. The IRS says that income must pass through and be taxed. We can't defer the taxes on that business income or the farm income. We do have some mechanisms of reducing that income, but we can't eliminate all of that through the use of the trust. So business income, though, with our trust is greatly reduced by the expense of the business and the farming, resulting in what they would call adjusted income for the business. This adjusted trust income is then passed through to a beneficial trust. In other words, we're using either a farm on like a Schedule F on your personal tax return, and then you run it through you pass that income through to a beneficial trust, and then you were able then to reduce that through some what we call some leaseback operations. I'll show you some examples here of how we reduce that business income. Let's say we got a business trust. That's usually the mechanism we want to use. You could use an LLC or a sub-S corporation or even a sole proprietorship, but let's mainly try to use a business trust. Again, our business trust, like the beneficial trust, is a titanium vault, so it's the ideal mechanism to use for operating your business. So we got a business trust now with $1.2 million for income. We got expenses of around $525,000, leaving us $675,000, a little more than $675,000 worth of net income. If this was a sub-S corporation, the taxes on that without using a trust would be roughly in 2019 $179,710 if we want to get to the exact numbers on that. But what do we do with our trust? We said we have what we call a leaseback mechanism. In other words, our business trusts own no assets. All they have is a bank account. So how do you operate your business if you don't have a vehicle, you don't have an office, you don't have telephones, you don't have any intellectual property? That's your how-to manual, your goodwill, your client list, or anything like that. All of those type assets are now owned by the beneficial trust, and the use of those assets are leased to the business trust. So in this example right here, we see we end up with having some total leases of about $555,000, which the business trust then can pay in a lease payment to the beneficial trust. So it's leasing all those assets, the office, the equipment, the intellectual property, for that $552,000. That is going to have a total effect then if they got other expenses of the 525 they had on the previous slide. We now have total business expenses of over $1 million, reducing their net income down to only $122,000 instead of the number we had on the previous slide. And we do that through that lease program. That's in fact turning lease expense. Of course, it's an expense in the business trust as a lease payment. It's lease income, and guess what? Lease income is passive income in the beneficial trust and can be tax deferred. So now the business trust has only got $122,000, a little over $122,000 as net income instead of the $675,000 we showed on the previous slide. So what happens now? We use a beneficial trust that has to receive that income, has to pass through by Internal Revenue Code requirements. So we now issue a K-1 to the beneficial trust for that $122,590. We have in the beneficial trust, though, we said we got other income. We got some interest income, some dividends, capital gains. We got rent. And then we also got that lease payment at $552,000 lease payment. So now we end up with the trust having total income about $790,000. So what do? We divide the business income into the total income. So the $122,000 divided into the $790,000 gives us 16%. So 16% of the income coming into the beneficial trust is business income. It's critical that we calculated that 16% because that's the number we're going to use later to see how much passes through as taxes. So now we got the trust income of the $790,000, and we got expenses in the trust of $98,000, let's say, giving trust income. This is the beneficial trust now, not the business trust. Beneficial trust now has adjusted income of $692,000. We multiply that again by that 16% of business income that came in, taking that number down to $110,000. It was $122,000. We now dropped it down to $110,000. So the $110,000 has to pass through, and taxes have to be paid on that. What happens to that remaining $581,000 plus dollars? That can be moved to the corpus of the trust, declared extraordinary dividends at the discretion of the trustee, and moved to the corpus of the trust and held there for other investments so the trust can continue to grow wealth within the trust itself. The $110,761 in this example has to pass through and be taxed. So let's take a look at what happens if we have a trust or we don't have a trust. So this slide kind of shows that we got a married filing jointly individual with 2 children. Without the trust, we have that $674,000 because we have no way of reducing that business income. We had that other income of $111,000, and we also got Social Security because you're old enough to get Social Security. So you get another $36,000 in Social Security. So now you end up with $800,000. Now that's $36,000. That's 85% of your Social Security, which is taxable. That's where the $36,000 came from. So now you got adjusted gross income without any trust of like $821,900. You got some itemized deductions, and you end up with taxable income of $752,854. So your federal tax looks like about almost $217,000 worth of taxes. Plus you got a state where you get 7%, California, some other states, another $52,000 worth of tax. You're paying $269,000, and that's because none of your child tax credit is deductible because you're over the limits. So you're going to pay Uncle Sam $269,000 plus on your taxes. But what if you had that trust? Now only the business income is $110,000. You still got your Social Security tax of your Social Security income of $36,000. So you got adjusted gross income now only on your personal income tax return of only $146,000. You now don't have any standard deduction items because your itemized deductions because they're all taken within the trust. So now you take the $24,400 standard deduction, taking you down to taxable income instead of $752,000. You now have taxable income only $122,000. Federal tax $18,000, state tax about $8,000 or so. We're giving you tax of $22,000 instead of $269,000. Not a bad deal for the trust. take a look at just how these taxable and non-taxable items take a look at. This is an example of what the trust or not having a trust does. So if you don't have a trust and you got contributions, medical is only what exceeds 7.5% of your adjusted gross income. Contributions, this slide shows 50, but it's really 60% now. So up to 60%, anything over up to 60% of your adjusted gross income for contributions. All the rest of those things, room and board at college, wellness, travel, all those other things, are zero on your personal tax return. But look over at the column for the trust. Every one of those expenses is 100% deductible with the Spendthrift Trust.